what happens is that, with mortgage companies, you have three credit bureaus: Experian, Equifax, TransUnion. Okay.
Right.
Now, of
Hmm.
those three credit bureaus, they're going to pick your median credit score.
Hmm.
So not your top score, not your bottom score, but the score that's left in the middle.
Hmm.
That is what your qualifying credit score is going to be. And then they pretty much will um, look at a certain type of a credit score, which is the mortgage version of the credit score, as well. And those scores kind of like vary from place to place.
Welcome to the Selling Sandoval podcast, where we dive deep into the world of real estate in sunny California. I'm your host, Victoria Sandoval, and I'm thrilled to have you join me as I sit down with top-notch professionals, market analysts, and influential leaders who have mastered the art of closing deals. Together, we'll explore the ever-evolving market trends, debunk myths, and empower you with the tools to negotiate like a pro. So whether you're a buyer, seller, or agent seeking inspiration, this podcast is your key to unlocking real estate success in California. This is the Selling Sandoval podcast. I'm Victoria Sandoval, and I'm excited to embark on this journey with you. Hi, everyone. Welcome to another episode of Selling Sandoval. I have a very special guest today to talk about something we're all interested in, credit, right? So my guest today, his name is Ali Zane. He's the founder of IMAX Credit. He is also a credit restoration coach. He's been licensed. He's licensed LDA in California, Superior Court, and has helped hundreds of clients. He's used to also run a mortgage company. Did I say all that right?
Yes,
Uh,
exactly.
there's
Amazing.
just Yeah. So you've done a lot, and you've been in the business for quite some time. How long have you been working on credit counseling or credit
Yeah,
coaching?
like, 20 odd years or so since 2004, or actually even prior to that in a informal sense, but
Okay.
it's been since 2004 till now, knock on wood.
Wow, awesome. And yeah, you've helped hundreds and hundreds of people, and you've helped them be able to buy a house and basically improve their credit score. So what got you into this business?
Yeah, so it's a very funny story. I used to work in auto finance and had a decent job, which was paying a lot, but it just didn't like, my soul just didn't feel fulfilled. And
Mm.
my uncle at the time, you know, kind of like borrowed him some money to start up a mortgage company. So he,
Oh,
about 6 months in, I basically quit my job and like, hey, let's figure out something for me to do in this industry. And
okay.
I remember we had and it was just this random thing that I just quit my job. I was so sick of it. So I
Mm.
remember sitting in his office and he's like, listen, we get a lot of customers that don't know how to that have bad credit. And at that time for him, he just didn't have anybody to help their clients with that aspect of things because,
Hmm.
he'd used some credit repair companies in the past. He was just not impressed. So he's like,
Right.
listen, I'll make you a deal. If you could fix that credit, only if you could fix that credit, I'll make sure you
Hmm.
get paid afterwards. So,
Mm.
so I had to figure out not only how to fix credit, how to learn credit repair, but my income became intrinsically tied to results, which was a very
Yeah, that's
different
great.
model in the credit repair industry. So
Right.
in that sense, right, a lot of people prior to that kind of like just did generic credit repair where they'd say, hey, we charge you XYZ for just doing this. Whereas my model, the way I was incentivized is I had to figure out solutions that worked.
Mm.
And anyway, so what ended up happening afterwards is that I ended up running his mortgage company on the side as well too. He ended up
Hmm.
going out of business in 2010 when the mortgage mess happened, and then you know our credit repair business type, kind of like took a life of its own after
Right.
2010. Because prior to that, I was just dealing with that mortgage company, and then I got out of the mortgage business, and then and I remember I think in 2013 or 14 we connected as well through Able.
Yeah.
And
Hmm.
it's
You
been
helped
that
me with
long.
my credit.
Yeah,
Yeah,
yeah.
yeah, that
So
was great. And it was quick. It was a lot faster than I thought. I mean, I was in like
I don't want to disclose, but it wasn't
Yeah,
perfect credit, but you got me up to the 700s in a matter of months. And yeah, it's result driven. And so that really impressed me because you have these other companies. I don't want to mention their names because I don't want to get in trouble, but they have like this monthly service fee. And
yeah,
so it's like it's to their best interest to not get results right away, right? So they want to
absolutely.
prolong the process, right?
Yeah,
So in this episode, I want to talk about like the credit score requirements to get approved for a home loan because everybody wants to know. And I know there's like different types of credit for different
yeah,
types of loans, right? And
yeah.
so let's talk about even if you're not looking to purchase a home right away, what target scores you might need when you are ready to buy, or if you are looking to buy now, what are the target scores needed, right?
Hmm.
And how we can get there. So I guess my first question is like, what are some of the common misconceptions about like credit requirements, basically in this field? Mhm.
Yeah, exactly, right. So what if I told you that a person that comes to you who's got okay credit has a higher chance of getting approved for a home loan than they have a credit card,
Wow. Wow.
right?
That would,
So
hmm
so I have people who've been able to get approved for home loans and they come back and say, "Hey, I was approved for a home loan, but I couldn't get a credit card." Well, that's very normal because, with when you look at home loans, they're collateralized, auto loans are collateralized, credit cards are not collateralized. So, for
hmm
instance, if you're to lend me money uh, in the form of a credit card, guess what? You can't take anything back aside from the plastic. But
right.
if you lend me money based on my home that you that I've purchased, obviously that home could be taken back, or if you do the same thing with a car. So there, for the lender, there's a lot of security when they lend on a home, and then also there's government backing as well too. So what
hmm
people think that, oh, I need to have perfect credit to get a home loan. No, 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 it's not. And then people
hmm
are surprised that, hey, I didn't get a stingy $300 credit card and have a $400,000 house. So that happens very, you know, it's a very common occurrence for people to have that misconception,
hmm
about credit. So the good news is that you don't need to have a credit to get approved for a home loan. You need a credit to get approved for one of those reward cards. Although you can
Right.
get like a crappier credit card with high interest rates, with not the best credit. But for a first-time home buyer, you could get a pretty decent home loan with low down payment, with I would say even like a below average credit score. Like a C credit score would get you a home loan, which is the FHA loan, which is the Federal Housing Authority back loan,
Right.
um, and so forth. So that's one of the misconceptions that people have, is that my credit needs to basically be, on a what on a rocket going to Sioux Falls, North Dakota. No, it just doesn't. It could be. It doesn't need to have. It doesn't need to be totally perfect, and whatnot.
Okay, perfect. So the reason why it's easier to get a credit card versus a home loan is because there's no I'm sorry, it's easier to get a home loan versus a credit card is because the collateral is what you're saying. And then
Yeah,
you said that in order to be able to buy a house, your credit doesn't have to be so perfect. You said C credit. What's C
I would
credit
say.
range?
Yeah, so basically, like A credit would be 750, B credit
Okay.
would be 700, B plus would be 680, C would be, I'd say, probably about 600 or less, right? Mm,
Okay. And
Uh,
and does
Go for it.
sorry, it does the same apply to luxury homes and investment properties
Yeah,
as
so for
far
the
as
criteria, if you're good, so the FHA program basically applies more to medium-sized homes. Uh,
okay.
so there you could have B credit, even C, and get a somewhat decent loan on, very average terms and such, and actually terms that you'd be somewhat happy with. Uh, but with investment homes and what they call jumbo loans, quote unquote, one needs to have a plus credit, right, somewhere in the 700s.
Okay. And then what about somebody that has unpaid collections? Are they still able to have a decent credit score? I had heard something about medical bills weren't going to impact your credit score anymore. Is that the case?
Yeah, so basically, so there are two laws that passed. Actually, one law that passed. Um, where the all paid medical collections would automatically come off people's credit report. That was not the case because before, even if you
Oh,
paid a collection off, it would still stay on your credit report as a paid collection, and it would still
right.
impact the score. But now, with this new law in place that this happened about a year and a half ago, that any paid medical collections won't. Now, from a lender's perspective, now if you have an unpaid collection, it will still factor into your credit score and still affect you. However,
Mm-hmm.
from a lender's perspective, like with FHA, I believe they say that you could have something up to, like, I'm not sure the exact number, but I'm gonna guess it's like $5,000 or $6,000 worth of unpaid medical collections on your credit report, and still
Oh,
get
wow.
approved as long as your score is high enough,
I see. Okay.
right?
So yeah, that's got to be it's I'm sure it's challenging to have a decent score when those items are reporting, but you got to be paying everything else on time, I'm sure.
Yeah, so I mean, it's like I said, right? Somebody could have multiple collections and still get approved for an FHA loan. I've seen that often, and
Hmm.
what have you. And sometimes people come to us and they say, "Hey, we want to touch things up, and we necessarily don't have to fix each and everything on the credit report to get them over the line." So, not
Hmm.
uncommon for people to have, a decent amount of collections and still get approved for a home loan.
Okay. And then what credit scores do lenders look at when applying for a home loan? Is there like do
Yes,
they look at one bureau or do they look at the high, the
yeah,
low?
so yeah, good question. So basically, what happens is that with mortgage companies, you have three credit bureaus: Experian, Equifax, TransUnion. Okay.
Right.
Now, of
Hmm.
those three credit bureaus, they're going to pick your median credit score.
Hmm.
So not your top score, not your bottom score, but the score that's left in the middle.
Hmm.
That is what your qualifying credit score is going to be. Um, and then they pretty much will um, look at a certain type of a credit score, which is the mortgage version of the credit score, as well. And those scores kind of like vary from place to place. So I'll give you an example.
Hmm.
If you're to go apply, Vicky, for a credit card of Bank of America, you go apply there, and they're going to pull a credit card version of the FICO score.
Okay.
Now, the very same day, if you go apply for an auto loan, they're going to go pull a auto loan version of the FICO score. And
Mm.
generally, when they're pulling your credit card score, auto loan score, they'll pull one of the three bureaus randomly. Now, when
Right.
you go apply for a mortgage at Bank of America, the very same day, they're going to pull all three credit reports and they're going to go pull a version just made for mortgages. Now, when
Mm.
somebody asks me, what is my credit score? I basically turn around and say, for what? For auto loans, for mortgages, for
Interesting.
credit cards? They're all different. And
Right.
the scores that you see on Credit Karma or the scores you see online are not the scores that the lenders are looking at. They're looking at a very specific version based on the type of loan uh, that you're going to be applying for.
Do you know what credit? Because I check my Credit Karma score almost weekly. And I
Yeah,
always wondered because I do know when I did apply for a home loan, it was way different. The score was way off, right? I feel like
yeah.
Credit Karma is much higher than what the mortgage credit score is. So you think you have all the, excellent credit, but then you're at a
Mhm.
B rating when you apply for a mortgage. So do you know, is that
Yeah,
like a credit card? Do you know if it's a like a credit card rating or if it's like
yeah.
is that
Thank
basically
you
what
for
it
that.
is?
Good question, right? I mean, Credit Karma is like a free website. It's used by, millions and millions of Americans. I'd basically go on to assume that that's the score that the US consumes the most. And
Hmm.
it's a score which is totally inconsequential that no lender really looks at. Now, Credit Karma, there are two companies that offer credit scores. One is FICO, one is Vantage. Unfortunately, 90 to 95% of lenders do not look at Vantage scores. So they're totally
Mm,
useless. And their score computation is very different than FICO. So sometimes,
interesting.
generally, I've seen Credit Karma be on the higher side, that Vantage score that Credit Karma shows. And sometimes I've even seen it to be on the lower side. So, a rule of thumb is that, you're going to have an overestimation of what FICO would be on Credit Karma, what FICO would be compared to the Credit Karma score. But,
Mhm.
there is really, I mean, I really don't take much from seeing Credit Karma. Now I have Credit Karma. I have it because it's free. It gives me Equifax and TransUnion, but I'm not looking at the score daily and making any deductions from it and assumptions. However, if my Karma score goes down by 100 points, it's an indicator that something's gone wrong, right?
Right.
So I look at it as a guide, but I never look at it to figure out like where I'm at in mortgage, because I've seen people with a 700 score on Credit Karma be, in the 500s, right? The
Oh
difference
my
between
gosh.
A and C, right?
Wow.
So,
That's
and
insane.
sometimes, yeah, and sometimes I've seen the inverse as well too. In some
Huh.
extreme cases where Credit Karma is very low and FICO is very high.
Okay. All right. So, what are some common misconceptions in regards to just credit in general? I mean, I know that there's just some people say, hey, you got to pay off your credit cards and close the cards and your credit score will go up, or just pay it down less than 30%. I mean, I just don't, sometimes I just don't know whose advice to listen to, or what's the proper advice, right?
Yeah, yeah,
So,
yeah. So generally, according to FICO, 3% down is sorry, 2 to 3% is the right utilization to have on a credit card.
2 to
That's what I'd say.
3%.
Yeah.
Oh, so it's not 20 or 30.
No, I don't know where 20 or 30 came from. And I've like spoken to like the head honchos at FICO and what have you, and this came from their mouth. And they basically don't really release much
Oh,
information because of the proprietary algorithm. They don't want you to
right.
know how this credit scoring system works. They want you to figure it out. That's one thing that they've basically said. They have published data on this, that from FICO themselves, that, this is what's happening now. Um,
Right.
so having said that too, about misconceptions about credit, generally FICO does put in some articles, and those are the articles that one should read. I have a blog as well too that, that I basically will write about credit and credit scores as such. But unfortunately, online, the problem is that, and even on YouTube, you have
Hmm.
influencers talking about credit that have never really repaired anybody's credit, you know
Hmm.
so they basically get information online and come up with their own spiel as to what happens. But you know I found like most of the people that really are knowledgeable about credit are not producing content. you know
Mm,
that's really what it is. So I follow nobody on YouTube. I actually follow one attorney who I know personally, but that's based on, he's an attorney. He files lawsuits against the credit bureaus and so forth. But as far as credit goes, unfortunately, it's very, very difficult to figure out what's right and what's wrong. If you had chat GBT something, half the time it's going to give you an incorrect answer because it's drawing from the web.
interesting. So your license LDA in California Superior Court, what does that mean?
Uh, so basically, I could, that allows me to file lawsuits in small claims, which attorneys are
Oh,
even not allowed to do. So that's a
interesting.
special designation, and what have
Okay.
you. And one of the reasons why we use a small claim court system is that it's a quicker means of resolving something, where you have a very specific date something has to be done by. Whereas if we go to civil court, which sometimes we do as well too, for larger cases,
Hmm.
those cases could take, 6 months or even a year, and what have you, based on, multiple hearings. Whereas in small claims, it's, something very quick.
Right. And that's the reason why you were able to get some items off of my credit actually 2 years ago.
Yeah, yeah, yeah. We did a combination of small claims and arbitration cases as well too.
Yeah. Because there were some errors, right? But it's like trying to get that resolved is like pulling teeth. I mean, had to go to you to get it resolved, and you got it resolved very quickly. So thank you for that.
Yeah, no, I'm glad that things worked out, and not everybody, and let me just say this too, like, not, I can't fix each and everybody's credit. Generally, I look at a credit report and look at certain coding violations on a credit report and see,
Mhm.
hey, what could we leverage and how we could leverage it. And often people don't, and often like, it's very difficult like for the listeners to figure out if they'd be a good candidate or not. And often it comes down to sometimes luck as
Right.
well. So yeah.
So walk me through, if I was a client, which I was a client, but I want the audience to hear this.
Sure.
I was a client. I contact you and I say, hey, I have some unpaid collections, or some collections that were paid that are on my credit report, have some lates. What would the next step for you to, what would you do next? You would run the credit, you would analyze it, and then, or what
Yeah.
actually?
Yeah. So, let's just say this too, right? Like when you reached out to me and, we did what we did, the first thing I asked you, Vicky, is like, hey, what are you trying to do right now, right? Credit's
Mhm.
basically, credit's in is not the end goal, it's a tool. And tell me what your end goal is. And you're like, hey, I want to get a mortgage and I want a certain, and then, based on that, I asked, hey, could you find out what score do you need to get approved for this mortgage? So let's look at the credit report from that particular lens because I'm not
Mhm.
a big fan of fixing credit for the sake of fixing it. For me, credit, I think, is something that people either spend, a lot of people, some of us may give it more, more power than it really needs. At the end of the day, it is a tool. And I'm here to make sure that people get approved for what they're looking for. And for that, I always ask
Right.
people that, hey, are you trying to get approved for a house? Are you trying to get approved for a car? And let's look at and let's set those goals based on that. Now, if I look at somebody's credit report and like, hey, your score is 580, and you're trying to get, say, $1 million home or $1.2 million home, and for that we need a
Yeah.
700 credit score. Even though
Yeah.
if I can get that client's credit score to 550, that doesn't change their situation, right?
Right.
So I need to be able to advise them on such things, right? Or somebody says, hey, I want to fix my credit because I'm going to get a house and I'm going to get an FHA loan, where the score criteria for that is on the lower side. And if I run the credit and see the score is good enough and say, hey, you don't need to fix your credit, just go get the loan and we could fix your credit, for other things if needed, but then that's not a priority for them, right? So,
Right.
so always the first step is to find out what their motivation is. What are they trying to get done? And sometimes people come to us and say, hey, my mortgage company said my score is 580. I need to be a 640, rain or shine. Perfect. I at least know, I at least have my marshaling orders and
Mhm.
have the parameters that I need to hit. And I look at everything based on that. And unfortunately, most credit repair companies don't really do that, right? They say, hey, to sign up with us, we'll see what we could do. Let's just go throw stuff at the wall and see whatever that sticks. So it's very, in unfortunately in the credit repair space,
Mhm.
we've not had like very strategic problem solvers, and a lot of people are looking for very strategic outcomes.
Right. Oh, yeah. So we have conversations with buyers every single day, and they sign up for these other services, and I've had clients that have been paying these services for 2, 3 years,
Yeah.
and they still
Yeah.
haven't got the results. So I always refer them to you, and you've done a great job with our clients as well. So thank you for that.
Yeah, and let me just talk about this too, right? Like, I mean, the credit repair industry is full of snake oil salespeople, unfortunately. The
Right.
largest company, Lexington Law Firm, got sued by the FTC
Oh,
for making for misrepresenting in their ads, um,
wow.
breaking the TSR, which is telephone sales marketing act, and what have you. And they had to file
Interesting.
bankruptcy. And keep in mind, this is a company that was making, I believe, 500 million a year. So they are the leader in this industry. So imagine in the banking industry, if you know Bank of America, Wells Fargo, Chase Bank, US Bank, all together were one company and they got sued and shut down. That's what Lexington Law Firm was for the credit repair industry.
Wow. So all of
And
my clients that, sorry, all of my clients that signed up
yeah,
for Lexington Law basically no longer are receiving their services, right? Or
they're in
they're shut down.
bankruptcy right now. They've
Okay.
got very big pockets. They're run by a private equity company in Wall Street. So they're still around
Okay.
and they've been, and I think the FTC's, I judge that they've been trying to get them shut down, but they're only
Mm,
taking a certain number of clients and they could not talk to people on the phone now. That's the ruling of this. So it's a different
interesting.
type of bankruptcy that they've gotten. And yeah, um, so my thoughts also is just around this, right? Like if somebody's been spend a lot of money with Lexington, they could report them to the Better Business Bureau, or
Okay.
actually better yet, the Consumer Financial Protection Bureau at consumerfinance.gov, uh, which is the financial regulatory agency that came online in 2011 after the mortgage mess. So you go on this website, you could lodge your complaints against any credit repair company. And especially if they're a big credit repair company, the CFPB will probably be able to contact them and try to negotiate the matter and get you a refund. So whenever somebody tells me that, hey, I've been defrauded by a company, and if that company has got a pretty big presence, these complaints work. Unfortunately, there are a lot of very small actors as well too, these mom and pop shops that are hard to track down and so forth, and those end up being problematic when somebody says, hey, I know a guy who fixed my credit and what have you, and it's just some person that is going to be hard to track down from from the consumer regulatory space as such. Because in California, for instance, right, like we're supposed to be licensed, bonded, registered with the Attorney General's office, and there are thousands of credit repair companies I would judge in California, or credit repair actors. Only 95 of them are registered and following the law, right?
Wow.
So odds are that if in this state, if you've come across a credit repair company, 9 times out of 10 that company will be conducting illegal business.
Interesting. So you should be asking if they're licensed and bonded, basically, when working with a credit repair company. Okay, great.
Yeah.
Well, you provided us with a lot of information, and obviously we can go on and on and on. We're going to do a 2-part series. So in session 2, we're going to talk about how one can improve their credit so that they can qualify for a home loan and get the best possible rate, right? So thank you so much, Ali. Now, how can one get a hold of you if they need your assistance?
Yeah, so my website, imaxcredit.com, would be the place that people could get a hold of myself and my team as well. So yeah, that would be it. So it's imaxcredit.com.
Awesome. And we're also going to have it on the link. So if you're watching on YouTube, his information will be on the link below. If you're listening in, it's imaxcredit.com. And thank you so much for your time. And I'm excited to do part 2. So you guys stay tuned. Thanks for watching if you're on YouTube, and thanks for listening, guys. Till next time. Bye.
Thank you for joining us on this episode of the Selling Sandoval podcast. If you've enjoyed today's episode, be sure to subscribe to our podcast and stay tuned for more valuable insights and practical tips. Remember, whether you're a buyer, seller, or an aspiring real estate agent, the Selling Sandoval podcast is your trusted companion in navigating the dynamic California real estate landscape. Until next time, keep dreaming big and making those real estate dreams a reality. This is Victoria Sandoval, signing off from the Selling Sandoval podcast, wishing you success and happiness in all of your real estate endeavors.